You are listening to the Winners Ways podcast with Bola Halabi, episode number 41.
Would you like to win and achieve success at what you do? Welcome to the Winners Ways podcast, where we create winners every day. And now, your host, the author of Winners Ways book and life coach, Bola Halabi.
Hello, my friends. Welcome back to another episode of the Winners Ways podcast, and thank you for joining me today. Today, we will be talking about investment. So this episode falls under your personal finance column, and specifically, we'll discuss fixed income investment strategies. So the topic for today is how to create a fixed income investment portfolio. I'm sure you know that there are various forms of investment. You can invest in the stock market. You can invest in real estate by buying properties and collecting rent, or by buying properties when they are low and selling when they are high. That's called flipping. And you can even start your own business. That's a form of investment. And as well, there is this fixed income investment, which is our topic for today. But before I go into it, I'll quickly like to talk about stock market investment, which is also called the equity market investment. Investing in the stock market or equity market will provide you two types of return. The first one is capital appreciation. And what do I mean by this? Capital appreciation occurs when, let's say, you buy the share of a company, maybe at $2, and maybe a year or two later, the company has done very well and their share price went from $2 when you invested to $15. That's capital appreciation. Each share that you bought has gained $12. That's capital appreciation. The other returns that you can get from equity market is dividend income. So most companies, if they are doing financially well, they also pay their investors some income based on the profit that the company makes. So you can get quarterly or annual income through dividend. Those are the two types of returns that you can get from investing in the equity markets. I want you to know that investing in stock market provides higher return, typically more than what you can get from fixed income, but also there are a lot of risk from investing in the stock market. For example, a stock may be trading at $10 today, and let's say you invest in the share of that company. Who knows? A year or two later, that share price can go lower depending on the performance of the company. So, as much as you can realize capital appreciation, you can also lose your money. So, that's the risk in the stock market that I want you to be aware of. Anyway, enough about stock market analysis. Our focus for today is fixed income investments. So, what is fixed income investment? Fixed income investment markets are commonly referred to as the bond market, and it consists of securities issued by federal government, corporate bonds, municipal bonds, and mortgage debt instruments. Investing in a bond is considered less risky than stock market, and because of this, they typically offer lower potential returns. Before we go into the different types of fixed income investment, I'd like to talk about why people choose this type of investment. What financial experts recommend is that as people move into retirement, fixed income instrument becomes more critical to preserve their capital and provide a guaranteed income stream. When I talked about stock market investment, we spoke about capital appreciation. What you get from fixed income investment is capital preservation because you don't want to lose your capital. Fixed income securities are commonly used to diversify an investor's portfolio because they reduce the overall risk of asset allocation. That means you should have a mix of stock market investments, equity market investments, as well as some fixed income investments in your portfolio as you are nearing that retirement age. Fixed income securities are generally more stable than pure equity holdings. Investors tend to rely on this asset class during times of economic downturn or when steady income is the objective of the investment account. So really it depends on your objective. Do you want capital appreciation? When you are 25, your investment philosophy should be mostly about capital appreciation. But when you are 55, you should be thinking more about capital preservation. I'm sure you all know about the 2008 global recession. Most companies lost over 50% of their values during this downturn. So imagine someone at 65 ready to retire. If they become impacted by such a huge loss, that's going to affect their standard of living during retirement. And we don't want that here at Winners Ways. So what are the advantages of investing in fixed income securities? Just as the name suggests, the income from fixed income securities is stable, and most of the time it's always predetermined. There are no potential for higher returns through capital appreciation or the opportunity to outpace inflation with this strategy. There are, however, some unique benefits that an investor can obtain through fixed securities. And I'll be going over those advantages. The first one is stability of principal. The fixed income security provide the peace of mind that comes from a stable portfolio balance and capital preservation. By definition, fixed income securities are required to pay the original amount of the investment after the maturity period of the investment. So let's say you invest $2,000 today and the maturity is going to be 2 years from now. You'll be getting some income during the period of 2 years, plus you will get your principal amount back at the maturity date. For fixed income security that are highly rated, as is the case of the US government bond, there is a minimal risk that the entity offering the fixed income security will be unable to repay investors in full when the investment matured. What that means is that US government has never defaulted on its loan obligation, and as such, the US government bonds are typically highly rated. And that's why it's always an issue when the lawmakers are debating the debt ceiling, when they are arguing, investors get jittery because they don't want the government, the US government, to default on their loan obligation. Number 2, fixed income investment strategy provide you steady income stream. So apart from the benefit of capital preservation, fixed income security provide investors with a steady stream of income. Bonds and certificates of deposit all pay regular dividend and interest payment to investors creating a consistent cash flow to investors. Fixed interest and dividend rates are set when the security is issued, and these payments are guaranteed as long as the issuing entity does not default. Federal government bonds are the least likely to default on interest and dividend payments, while corporate bonds with lower credit agency ratings bear more default risk for investors. Number 3, higher priority claim to assets. If a company gets into financial trouble and needs to declare bankruptcy, the fixed income investors will be given higher priority over stockholders. Investors in bonds of a corporation typically have a higher priorities over common and preferred stockholders of the same corporation should a company declare bankruptcy. What that means is that a bondholder will typically get his money back before a common or preferred shareholder of the same company. Bondholders then are more likely to be repaid their principal investment when assets are distributed during a liquidation event. Good so far? Now let's get into the different types of fixed income investments. I have 5 types that I'm going to share today. Hopefully, you'll be able to use one of these as a way to earn your fixed and steady income stream. The first one is savings accounts. A savings account provides a safe place to store your cash and earn some interest. The savings account is easily accessible, and there are typically no fees or terms on most savings accounts. There may be some restrictions on the number of times you can withdraw your money from your savings accounts in a month. The interest rate depends on the countries and the economy. During this period, the savings account in America generates on average about 2.25% per annum. I know that is super low. Some countries can pay as high as 10% depending on their economy. And again, recently the Fed cut interest rates, so that's going to affect what you have in your bank. Maybe if you are getting any interest on your savings. And this Fed cut this interest rate so that they will encourage borrowing. So if you are a saver, you are losing money by putting your money in your savings account. The second one is a money market account. The money market account is similar to the savings account in many ways, but it pays a higher interest rate than the regular savings account. They also have limits on transactions, but you can have immediate access to your money with a money market account. The current average interest on money market accounts is around 2.5% in the United States of America. Again, that is low, but what I'm saying here is fixed guarantee income stream. The third one is certificate of deposit. A certificate of deposit, or CD as it's commonly called, is a type of savings account that has a fixed interest rate and a fixed maturity date before you can withdraw your fund. A CD does not charge you any fee unless withdrawn before maturity date. It's a low risk and low interest form of investment. Typically, the average interest paid on CD varies from 0.5 to 3%, depending again on the country and the overall health of the economy. The maturity term on a CD can range from as low as 12 months to as high as 5-year CD. So you got to be sure that you can leave your money till the end of the maturity date before you can consider putting your money into this certificate of deposit account. Number 4, the bond. Bond provides an opportunity to earn a fixed income. Government and corporations typically issue bonds, and they are interest-bearing security that obligates the issuers to pay the bondholders an agreed amount of money at a specific period, with the goal of repaying the principal amounts at maturity. It is as if you are loaning the issuer your money. In return, you are getting some interest payment on your loan. The rate you get on your money depends on the financial health and rating, as well as reputation of the issuing organization. Organizations are given ratings from AAA, being the strongest with good financial standing, to junk rating or C or D, depending on the financial health of the organization. The companies that carry lower rating typically pay higher than the ones with higher bond rating, but they also possess higher risk. The coupon rate ranges from as low as 2% to as high as 12% based on the financial health of the issuer, and that's bond. If a company is well rated, like AAA, they may be paying you as low as 2% on your investment because they have lesser risk of defaulting. But a company that is rated C or D can typically pay you 7 to 8% on your money. And please note, they have a higher risk of defaulting on their obligation. The final one is annuity. An annuity is not widely accepted as an investment vehicle because it is mostly sold by insurance companies. It pays out income and can be used as a part of retirement strategy. Annuities are a popular choice for investors who want to receive a steady income stream in retirement. So how does it work? You make an investment in the annuity, and it then pays you on a future date or series of dates. The income you receive from an annuity can be cashed out on a monthly, quarterly, or on an annual basis. You can even get your money in a lump sum. You can opt to receive payment for the rest of your life or a set number of years. How much you receive depends on whether you choose a guaranteed payout, that's a fixed annuity, or a payout stream determined by the performance of your annuity underlying investment, that's a variable annuity. And that's it. You learned about 5 different types of fixed income investment portfolio. We talked about savings accounts, money market accounts, certificate of deposit. We talked about bond. And lastly, we spoke about annuity. Now you know what fixed income investment is all about. You know the advantages and the shortfall of fixed income portfolio. You have learned about some examples of fixed income investments. So depending on your situation and your financial goals, you can either use the fixed income strategies to build your portfolio or a combination of both fixed income and equity market investing. I hope I've been able to serve you today. I hope you will join me again next week. You know I'm here to help you to win in your finances by providing this useful information. By the way, I need your help in return. Please head to iTunes or anywhere where you listen to podcasts and rate our show and leave us a review. We use these reviews to reach more people so that they can also join the Winners Ways community. And I'll give you a shout out on this show as well. Till next week again, thanks for listening. Now, go win.
This episode of Winners Ways podcast has come to a close. We hope you enjoy and learn something from today's show. We want you to win and excel in all areas of your life, and we regularly explore and share information with our listeners to empower them to win. Be sure to subscribe to our podcast for more tips and strategies to help you find the success that you've always dreamt of. And don't forget to rate and review so that we can continue to bring you more podcast episodes to empower you. We will love to have you again next week. Now, keep winning.